Good afternoon. Welcome to our webinar, What Should Income Investors Do Now? I'm John Stepek, the Executive Editor of MoneyWeek magazine, and with me today are Matt Conradi and Iain Barnes, Challenger Wealth Manager, Digital Wealth Manager, Netwealth. And thanks to so many of you for tuning in today. Please do send in any questions as they occur to you. We'll have about 10 to 15 minutes for Q&A at the end. But if there's any ones that are particularly pertinent to the topic in hand, I'll just grab them at the time. Now, I last spoke to Matt and Iain at the end of March, and that was literally a couple of days after the market hit its coronavirus panic bottom on March the 23rd. Now, since then, markets across the globe have rebounded sharply, led by stocks in the US. However, while a great deal of ground has been recouped in terms of share prices, the crisis promises to have a much more lasting impact on dividend payouts, as many of you will have noticed. And the FTSE 100 has always been something of a high yield index, but even some of the most historically reliable pairs have had to slash or cancel their dividends altogether. We've seen huge names like BP and Shell are classic examples of this. And meanwhile, central banks clearly have no intention of raising interest rates anytime soon, which means that bond yields seem unlikely to rise anytime soon as well. So if you are an income-focused investor, you might feel somewhat under siege right now. What are you going to do? Do not fear. For the next 40 minutes or so, I'm going to talk to Matt what really matters when it comes to generating income from your portfolio. And you should come away with a better understanding of how to think about income as part of your overall investment strategy. So first, I'm going to let my guests introduce themselves. Matt, can you tell us a bit about yourself and what you do at Netwealth?
Hi, John. I head up the client advisory team at Netwealth. So myself and my team work with clients to think about their goals and objectives, what they're trying to achieve, whether that be retirement or funding school fees, and then think about how to structure portfolios to generate the cash flows they need. So if it's income they're looking to generate, how should they invest for their different goals and objectives across that? And then think about things like tax planning and putting in place structures such as pensions and ISAs in order to do that really efficiently.
That's great. Thanks, Matt. And Iain, can you tell us about what you do?
Yeah, sure. I'm the head of portfolio management at Netwealth. I joined Netwealth at the launch to structure the 7 investment portfolios that we run, accommodating a range of different risk profiles for clients. And alongside Dr. Jared Lyons, our chief economic strategist, we run the investment process to be responsible for the outcome of those portfolios.
That's great. Thanks, Iain. Now, before we get into the meat of this discussion, I just wanted to pick your brains on what's happened over the last few months, because clearly it's been quite dramatic. As I said earlier, we actually last spoke to one another when planning was very much the order of the day. And as is typical, that was actually the market bottom. Have you been at all surprised by the strength of the rally since then?
Yeah, I think it's been a pretty remarkable period for markets, and as you say, the first quarter of this year was one of the worst in history across the world. And I think what we've seen this more recently is this battle between ongoing very weak economic and corporate fundamentals being challenged by the amount of monetary and fiscal stimulus that's been thrown at investors by the authorities. And I think what has been particularly interesting for us is the way that the recovery has taken place in different markets at different times. So you saw a sharp correction in investment grade corporate bonds as the central banks led by the Fed came to directly promise support to that market. And you also saw very immediate strong performance by some of the consumer technology names that that we're all familiar with that have led the US market for so long. And if we look at the slide just sort of showing this, the returns that we've seen over the year so far, you can see that the broader market performance is in a lot better shape now than obviously at the end of March. And global equities in sterling terms are now up in positive territory led initially by the US. What's interesting, however, is more recently the way that European markets have also come to the fore alongside the performance of Asian equities as well, resulting in the fact that the UK is really looking like a bit of a laggard in terms of equity movement so far. I think
Yeah,
what we're sorry, go ahead.
no, so it's very interesting there looking at that kind of chart, because you get it's you've still got the US in the lead, but I noted your comment about Europe catching up. Do you think that, because obviously Europe's been underperforming for a long time, do you think that's sustainable? Do you think that's driven by the sense perhaps that the US is facing a second outbreak?
So we think it's a combination of a few things. We think it's been very interesting that over this last period, where some of the health news in the US has really taken center stage, that even the markets which are considered slightly more cyclical, so European equities, emerging markets, and even small caps in the US have actually held up okay in that process. Usually, when US large caps start heading downwards or stumbling, the rest of the world underperforms at that point. Um, I think it's also interesting to think about the different dynamics that are in play with the broader pricing of markets. So we've had this phenomenon where quality growth oriented companies have done particularly well, and for us the sustained performance from Europe or other areas which have been slightly sort of better value would need to coincide with a real change in market dynamic towards a sustained economic rebound. And I think the jury's still out on whether or not we can see that take place.
Yeah, and I mean that takes us to another point. I mean, a lot of people look at the state of the economy. We kind of get mass unemployment across the globe. We get collapses in GDP, kind of record collapse in GDP in the UK just recently reported, and they do get confused by the strength of this rebound. I mean, what do you say to people when they say, "Oh, how can this be happening? Why are stock markets quite as detached from what's going on around them?"
Yeah, well, exactly, and it's quite it's as we all know, it's very hard to think about market movements purely in terms of what the broader economy is doing. But it's really been highlighted by the fact that the second quarter was the best one since 2009 for global equities in dollar terms, at the very point in time when it had the weakest economic performance. To us, that really just reminds us that it's very hard to anticipate exactly when markets are going to respond to economic fundamentals or intervention from, say, um, central banks, or socio-political challenges that are always going on around the world at any point in time, and just makes us aware that you really just need to make sure you've got your risk profile right for your portfolio, for your own objectives, and trust in the fact that markets will deliver value through time. And one thing that we've been highlighting to clients is that even during the point in time when the first quarter, as we've been discussing, was showing some really negative, sharp moves, we didn't really hit the ranges of expected returns that we try to characterize to investors before they invest. So one slide that we've been showing a lot is the range of portfolio outcomes that you might expect through time, using the best experience over a 12-month period and the worst. So if we can see that slide, we'll help that put that into context. So here we can see that the yellow dots are the range of portfolio performance over the first quarter of the year, and you can see, although that sharp moves lower, as we've discussed, didn't get to that point where investors should have been surprised at the potential outcome, because the grey bars show the minimum 12-month return that you would have seen for this strategic allocation of assets over the past 25 years, in contrast to the dark blue bars, which show the maximum 12-month return. And so one point we like to make was that, yes, you saw this sharp drawdown represented by the yellow dots, and yet if you took away those yellow dots from this chart and looked at the broader picture, you can see that the blue dots, which represent 1 year performance over the 12 months to the end of June, you'd have thought it was a pretty unremarkable year. So trying to anticipate exactly when a market might decide to turn is just a real challenge, and that's why we just say, get your risk budgeting right, and be sure that you're invested in a diversified group of asset classes.
See, that is actually, I mean, that's really fascinating to me because, given the sheer pain of the collapse, the idea that by this point, many people could have gone away, gone to sleep, and now be looking at their portfolios and thinking, actually, that's been kind of a dull year so far. That's pretty kind of dramatic demonstration of the importance of diversification and also of not making kind of daft mistakes at the wrong point in the market. However, going back to the main topic and income, obviously markets have bounced back quite dramatically, but the cuts to dividends do seem as if they're probably likely to last for longer. I mean, I'm a big fan of dividends. All of the readers are too. I mean, do you think that they're likely to bounce back with earnings, or is this possibly even like a kind of a new normal, as it were?
Yeah, so I think that that's one of the reasons why the UK market has underperformed the broader universe, is that people have historically looked to the UK market as a source of dividends. There's a very strong dividend culture within UK investors, and the uncertainty around that stream is really coming home. And we think that maybe investors looking further afield have got greater conviction that the earning streams that have been delivered and the way that cash flows come back to investors are going to be more stable in the future, more predictable in the future than the UK. Now, I think although clearly the pandemic caused massive issues for companies that are paying their distributions, you could argue that with payout ratios being relatively high historically within the UK, that some of those stated yield objectives that people had in mind should have been called into question already, because there's a point when a high dividend yield, although extremely appealing, probably represents a riskier investment than you might otherwise think of. So a good example is something like commercial property, where people have been very used to thinking of this as a quite a stable asset class, relying on ever growing rental growth. And when that particular story comes to a sudden stop, as we've seen with with landlords being unable to collect a lot of the commercial rents that they're due, then suddenly the whole investment thesis behind a lot of these companies sort of falls apart. So we think that there's a real risk that people are a lot more cautious on relying on dividends as the main source of returns in the future. You might see that percentage yields stay elevated, but that might be because dividends are taking a notch down as people reset their payout structures, but also because of the uncertainty, investors are not willing to bid up the capital number that that represents the denominator in that payout. So we think that there's going to be a level of uncertainty for an ongoing period of time.
Yeah, and I think, to be fair, you're right. There has been this sense because, I mean, there's been no end of talk about how many of the payout ratios in the FTSE 100 we're close to kind of like 20, 25-year lows. And I think a lot of the time what's happening with that is that both individual investors and to an extent fund managers have sort of just crossed their fingers and hoped that because these companies have kind of perhaps had long track records of paying out dividends, that in a way the the low kind of like payout ratio just really or rather low dividend cover didn't really matter, and it was something that could be ignored or put down as a almost an artifact of kind of low interest rates. And unfortunately, clearly, the coronavirus has proved that that is absolutely not the case. I mean, in terms of generating more sustainable income, are there other asset classes that people should be looking at? Is it a mistake? Is the mistake that people are focusing too much on dividends, or does it go kind of deeper than that?
Yeah, so when we're putting portfolios together, the way that we think about things is that you should really be focusing on your total return objective. And Matt will go into a bit of detail about how we can structure portfolios so that people get the the cash outcome that they need from their investment portfolios. But there's a real risk that if you just focus um, on investments which pay income of different forms, then ultimately you're not going to be as diversified as you're hoping to be, because a lot of these uh, assets will all be driven by the same underlying themes. So in a distressed environment where you're seeing you're seeing yields fall, you're seeing bank rates fall, then income more broadly becomes a lot more challenging. And if you just focus on maintaining a set level of a dividend stream, then you're going to find yourself getting forced into riskier and riskier assets as you stretch to maintain that yield. And we think that that's a really, a really important thing to try and avoid. Rather, you should be focusing on different assets which can provide you with some capital growth to offset the type of environment that where you might see income streams come under pressure.
No, it's okay at the moment.
I mean, talking about that kind of desperate reach for yield that we've been seeing from people. So one mistake is that people focus far too much on I've got to hit that kind of magic number in some way. And also there's the issue that they kind of worry about they focus too much on the number, they don't focus enough on the security of the income. What other kind of mistakes do people make whenever they focus too much on this idea of I mean, the way the industry does kind of encourage it, because we have obviously equity income funds, big kind of sales point, and we tend to separate things into income and growth. I mean, do you think that kind of leads to the wrong kind of mindset?
Yeah, maybe I should take this one. It's a funny world where income is sometimes used to describe defensive assets. So in multi-asset portfolios, you have an idea that income is the defensive portfolio, and it isn't necessarily. If, as Iain pointed out, you're targeting higher levels of yield, you can get forced into asset classes that, in order to generate that yield, are taking more risk. So high yield debt or commercial property or so on. But also, I think the trap that people fall into around income is thinking of income specifically as dividends coming in and they're having to receive a cash flow in, rather than thinking of it as income that they need to receive in their bank accounts to live off for themselves. That's a different thing, and that can be achieved more holistically with a total return approach that perhaps would diversify that risk a bit more, spread out the number of assets you could get in, and allow you to identify more value. As Iain said, when interest rates are this low, all income assets are going to be priced off that starting point. And so there is no sort of free, high yielding asset that won't be with it bringing some level of extra risk as well.
The thing is, though, I mean, the problem is it's very easy to fall into this feeling of I have to protect my pot, because these days, and I think it's fair to say to a greater extent than ever before, we're all being expected to take much more responsibility for our own retirement pots than at any point. And I suppose what I would say is I can therefore understand why people feel that, oh, look, well, I need to kind of save this big pile of money, and then that's almost going to be like a bank account for me. I have to take this capital, I have to park it somewhere relatively safe, and then I have to live off whatever interest rate I can generate from that. Now, clearly that's not the case, but it's very difficult to get out of that mindset. So what is your advice to people in terms of adjusting how they think about that? How do you find how do you get out of the idea that you need to preserve this big pot for good? And B, how do you kind of work out what is a sustainable rate at which to, if you like, run it down?
Yeah, I think, John, the first thing you say is getting out of this mindset that you have to maintain this pot that you've built up, particularly from a retirement perspective. So if we think about pensions, historically, as you got closer to retirement, you wanted more stability in your pot because you were going to go and buy an annuity. And what the pension company did, or the insurance company did for you, was turn that into cash flows, and they were spending down your pot and depleting your pot over time. What we're doing now ourselves in many instances is investing for drawdown, but we have to accept that the term drawdown suggests it, and it is true that you should be drawing your capital down over time as well as your income. So if you have a mindset of just spending income, either you're going to take too much risk or you're going to live a very frugal life, or you're very lucky in that you have a large enough pot with the meager rates that are available that it can be sustainable. You then need to think about some of the elements that will make the decision for you as to what is a sustainable level of drawing. And this is always a challenge. The idea of spend your income and maintain your capital is a nice rule of thumb, and it's a sensible starting point in many instances to not draw too much. But with the world where we are today, we need to perhaps adjust that. It's the same as saying, don't put all your eggs in one basket and don't be diversified. It depends how you achieve that. If you're diversified by having 4 different UK equity income managers, you probably don't have much diversification. You need to get diversification of different sources of return, whether that be from some fixed income markets or from different regions as well. So it's a factor of understanding where the rule of thumb applies and where it doesn't, and then thinking about the challenges that you face. So this could be things like inflation over time. If you're going to be thinking about drawing down assets and capital, you need to think about the level of inflation you'll need, how your spending will evolve as well. So in retirement, it's likely that when you first start to draw from a pot, you'll want to draw more. It's okay to spend some of your capital at that point. And then as you get older, it's likely that you'll start to draw less, you'll do less things, you'll need less. And then perhaps towards the end of your retirement, you might need to cover costs of care homes and so on. But there are other sources of capital to do that, perhaps your property and so on as well. So I think it's about putting in place a plan and then understanding how to model for those variables and what would be a sustainable rate for you. Because if I say to you, 4% is a great number, you can definitely draw that from. Well, it's not quite true. It depends how long your retirement's going to be, what level of inflation you meet, and so on. So there's no hard and fast rule, but there are ways to model and understand for that set of scenarios that you need to meet.
And just as to try and give people some, I don't know, practical examples or practical ideas that they can take away. I mean, you mentioned the 4% drawdown rule there. I mean, I think that's interesting because that's one that comes up again and again and again. But really what you're talking about is having a more flexible approach so that if you're, like, as you say, whenever you turn 65 or 70, or whenever you want to retire, that's often a point at which you splurge, and then later on you get back to normal. So in terms of things that people can do, what would you suggest to someone right now, for example, who is kind of heading towards retirement and they are thinking, like, well, what steps should I be taking just now in order to make sure that my pot is big enough to generate the kind of income that I need while I'm no longer working?
Yeah, so I think the first thing to do is to take stock of the assets that you do and don't have, understand where you are, think about than what your expenses are likely to be. What amount would you like to begin with? And then you need to start thinking about the things that you can't control and the things that you can control. And perhaps there's a slide we can look at now to think about that. What we have here on the left-hand side, the slightly grayed out sections are the parts that you can't control. And that's things like market performance. So you need to understand what level of return you might be able to achieve for a given level of risk before we looked at those ranges of outcomes that might occur. And that will drive the level of return you can get, but also the level of risk associated with it. You need to think about things like inflation. What level of inflation are you going to factor into your future cash flows that you're going to draw from it, or are you going to use that as a way of reducing the amount you draw period on period by saying you're going to take that inflation on board yourself and reduce the amount you need to get in real terms? Also, how long are you going to live for? That also makes a massive difference to what's sustainable. If you're retiring at 60 and you're going to live to 80, then you don't need anywhere near as much as if you're retiring at 50 and you're going to live to 95. And you really need to think about what the risks are. If you've thought about those elements, then there are some really simple, sensible things you can do to make sure you get a better outcome. And those are the things that we can control on the right-hand side. And they're things that we really focus on with clients. The first is trying not to time the markets too much. Right now has been a time where it would have really felt like you should try and protect yourself, particularly if you're coming close to drawing down. Should you be selling out? Should you be trying to buy back in at the bottom? Generally, what we find is that actually destroys capital. People don't get it right consistently, and they end up worse off. As we saw with the chart earlier that Iain was presenting, if you look at the 1 year number, you're pretty much flat, although the path has been quite volatile. So trying to get in and out is difficult. So don't chime the markets. It's a really long-term goal. In most instances, if you're drawing an income, it's because you need an income stream for a long period of time. So there's going to be lots of ups and downs that occur, and you shouldn't get too fixated on those happening and trying to move around them. Being diversified, though, will help to minimize those ups and downs. So having a level of different asset classes that can provide different sources of return and different risks will smooth the path of return. So particularly if you're going to be relying on the assets to draw from, this becomes relevant. And whilst you can be diversified in your dividend streams, so you can have just dividend stocks that are trying to give you income and have a range of them, that will help. That'll remove the risk of any one company's cut hurting you. You want to think about diversifying asset classes altogether, because that will smooth the path of return. You want things that are perhaps less correlated. So if something goes up when something's doing well, you want something that goes down at the other time, and vice versa, that will protect you in it. So being more diversified, we think, is a really important thing, particularly when drawing from assets. And then you need to think about using tax wrappers to your advantage wherever you can. Think about the income that matters to you is your net income. It's not necessarily the income that is paid by a company stock into a dividend into the portfolio. It's the net level of income you need to get in your bank account. So there are ways to make that outcome much better, which will actually reduce the amount of gross return you need to achieve over time. So how you structure your savings, how you draw from your savings, particularly around pensions and ISAs and so on, makes a big difference. And then the final thing that we think you can definitely control that makes a big difference when we're talking about goals that are likely to be 30 or 40 years long is the minimization of fees. Keeping that cost of investing down will help give you better net returns, and you keep more of that. What you don't want to do is have a large chunk of the return you're making get lost away on costs of investing over time. So when we're getting to this point, you need to think about the things you can't control and model for them and understand for them, and then control the elements that you can to get better outcomes overall, and that will give you a much better setup. Some of the other things you can do is just think about your assets forming different pots and what you can do from them. So if you are going to need to think about what assets you have today, something we do is think about 3 different pots. Pot 1 is your liquid pot. It's your cash. It's your dividends perhaps coming in that you're living from. As you get closer to retirement, this pot needs to probably be a bit bigger. It allows you the ability to ease off. So if you have been focusing on total return, perhaps, and markets have sold off, you can stop drawing from your portfolio for a few months and draw from your cash instead. Similarly, if you're drawing from dividends and you see a cut to those, you can dip into cash while you think about rearranging your portfolios. At the other end of the spectrum, you have those less liquid assets. These are things like properties. There might be direct investments or single stocks. For that section, as you go into retirement again, you're probably going to want to minimize them. We talked a bit about commercial property before. A lot of clients have thought about having a property, living off the rental income from that. The problem comes when you don't get the rental income, you have a void period. You can't just sell a chunk of that property in order to meet your needs. And so I think minimizing your exposure to the pot three less liquid type elements is probably relevant over time. And having a core in the middle where we think of multi-asset portfolios really play their role. This is about having diversified portfolios, and blending that and your pot one will help you be more prepared for your retirement over time.
Just on those, I think that's very interesting. Again, it raises a lot of questions about how we've traditionally thought about retirement. One of the points I was going to ask is, how long do you think that we should realistically plan to be retired these days? Because obviously in the old days, we would retire at 65, we would buy an annuity, the annuity would pay us, and it didn't actually, from that point of view, it didn't really matter how much longer we lived. You either get great value from your annuity if you live for ages, or you get terrible value if you die the next day. Now, clearly that's changed, and again, we're the ones that are going to have to essentially provide for our retirement. So what kind of age do you think that people should be planning to be on the safe side?
Yeah, it's a very good question. So with clients, when we're thinking about a couple, and it's particularly relevant to think about a couple, you need to provide for both of you. We generally work to age 95. So that isn't to necessarily say the average life expectancy for someone in their 50s and actually 60s, it doesn't really change that much depending on whether you're 55, 65 or 60, is around 86 to 87 years. But the average isn't what you plan for. The risk is that you live longer. And so we generally work to age 95, and with the expectation at that point that clients would still have some other form of assets as well. So that might be property or so on that they could draw from if they need to. If you then do all the sensible things that we talked about, controlling those outcomes, you should still be able to get set a level of income you can draw that will meet that level. And if something's left behind, then that's structured in a way that's sensible and it passes to you rather than to the insurance company. So if you think of an annuity, when you pass away, that value disappears. If you're drawing down and you have that structured sensibly, perhaps the money is left behind in a pension, it'd be outside of your estate and can pass to your beneficiaries as well. So plan for a long time and structure in a way where if you do pass away earlier and there's more assets remaining, that those can pass on in a sensible, efficient way.
Yes, and I think that leads on to just another question I was going to ask about that. Again, during the kind of annuity days, we always had this model of lifestyling. So the idea is that you go from having whatever 80% in equities and when you're in your 20s to more of a 60-40, but it's kind of 60% equities, 40% bonds, and then even less, and that you would gradually ramp up the amount of bonds in your portfolio as you got nearer to 65 or 60, and you decrease the equities. How do you feel that has changed, given that a lot of the time you're going to have at least some exposure to riskier stuff even while you're retired?
Well, it's definitely right that you should, because the target of what you're trying to do is completely changed. If you were trying to move towards buying an annuity, then your focus was on maximizing the value at that point in time. Now you're looking to build a stream of income over a longer time period, and perhaps Iain can talk more specifically to that.
Yeah, I mean, so we think that clearly your overall goals will need to be driven by personal circumstances, but inevitably as you're investing for a sustained period of time, you need to make sure that you do still have access to some growthier investments rather than just focusing on anything that will just deliver you your income streams. And one thing that we think is particularly important is trying to make sure that when you're framing your overall portfolio construction, the assets that you have in there playing defense, if you like, are ones that are truly, protective against different risk scenarios. So we've been a believer in making sure that you do have some fixed income assets in all portfolios, just to make sure that you're getting that smoothed path of returns, which is so vital. Just make sure that you're that you're getting the portfolio construction right for optimizing that overall total return, I think, rather than anything else. And particularly at the moment where you have interest rates, as we've discussed, at zero, then trying to understand how different asset classes behave in relation to that base is going to stay important for the foreseeable future.
Just on that topic, can I ask what asset classes you particularly focus on in your portfolios? Because I realise you've got a kind of range of risk going from 1 to 7, isn't it? What sorts of things would you have in the high risk chunk that you wouldn't have in, number 1 or number 3, say?
Yeah. So the first point is that everything is got 100% daily liquidity within portfolios. As Matt mentioned, the role that we see Netwealth portfolios playing is this sort of this middle bucket of realizable assets, which should still improve in value through time. Up towards the top end, then we think you should be focusing on a diversified pool of equity assets. We do include some riskier fixed income. At the moment, that's focused within emerging market bonds, because we find that they provide a helpful diversifying impact through time. As you progress lower, then yes, you are transitioning into more traditional safe asset classes such as fixed income. We'd been underweight corporate bonds for a number of years, but recently increased that allocation back up to what we would imagine as our strategic position after the sell-off that you saw in February and March. So that dynamic and having high quality fixed income is still an important component. What we don't have at the moment is commodity exposure, and that's one thing, a discussion that we think is going to be extremely important on an ongoing basis, is how the world reacts to the current environment, and also some of the support that's been provided with regards to future levels of inflation. Now, as Matt mentioned, everyone has their own personal level of inflation, which can, vary depending on circumstances. But it's safe to say that so far inflation has been pretty well behaved over the course of the past 10, 15 years. The outlook at the moment is a little bit more uncertain, and that's something that we're concentrating on a regular basis within our investment committees.
That's interesting. On commodities, if you did decide to get exposure to that, have you got thoughts on how you would play that? Is that just through kind of equity risk? Would you be looking at potentially direct exposure to commodities? Because I know this is always they're a fascinating asset class, but they're not always the easiest to get exposure to.
Yeah, so we invest in mostly in passive building blocks, and so that would be our first port of call in thinking of that. Of course, you can have different equity sectors which are much more attuned to the commodity cycle as well. Typically, we would look to invest in a broad basket rather than focusing on particular areas. We think that a lot of people get caught out as essentially as tourists in the commodity sector, not quite understanding the way that different instruments will behave through time. And you saw a great example of that in March with the movement of the different energy sector futures, which burned a lot of investors outside of the specialists. So that would be our port of call. A lot of people talk about gold. It comes up quite a lot, and that's one of the assets that has done particularly well this year. We're always very cognizant of the very particular environments where we think that gold performs particularly well, and typically that's when real interest rates are falling, as they have been in the around the world more recently. We don't necessarily think that gold is always the answer to every inflationary problem.
Just on that point about real interest rates, do you think there's a better way to play that than gold? Because I know that there are obviously kind of various. I think you're absolutely right. I think real interest rates are the key drivers for gold, and people sometimes get confused by the fact that it's not falling real interest rates go with rising inflation, but it's not necessarily the inflation itself that's driving the gold price higher. It's the fact that real rates are falling. I mean, do you think there's a different way to play that represents a less risky bet than gold, or is
Yes,
it just preference?
yeah, well, I think it is just preference ultimately. But so for our US dollar portfolios, we've been have had allocations to inflation protected treasury bonds, which map pretty closely through most periods of time. The one thing that we think is particularly important is making sure that you're investing the different characteristics that you're investing in gold for, or any type of instrument like that. A lot of sterling investors have been holding it, and much of the benefit through time has come from a depreciating pound against the US dollar. So if you've gone down that route, then I think it makes sense to make sure that you're exactly clear, the type of instrument that you own and how it might behave as a UK-based investor should the current environment of sterling depreciation.
Yeah, and just one final thing on the assets that you use. I noticed that you didn't talk much about commercial property, and obviously property in general was often seen as an income asset or a kind of resilient, almost index-linked asset. Is there a reason for that? Do you have much exposure to commercial property?
Yeah, so we don't. We think that you get a fair amount through the domestic equity market anyway, just because of some of the constituents that make up particular indices. We found that we're trying to occupy a space where you've got 100% liquidity, and when people are investing, part of the value historically from investing in property has been this illiquidity premium. So either you are going to invest in a structure which turns that turns it into a more liquid asset, say REITs, in which case you tend to lose some of those particular characteristics that you're originally targeting because they behave a little bit more like equity experience anyway. Or you invest in an asset where you could be disappointed. There's a lot of discussion always about whether these daily accessible commercial property funds, whether or not the gating aspect or withholding access to your money is actually a bug, or if it's a feature of the structure. It's designed to be in place and to be called upon pretty regularly in current times. We just feel as though neither of those are particularly relevant for our portfolios, and we don't miss not owning them. And that's aside from the fact that, as Matt touched on, if you're looking, a lot of investors feel as though they have enough exposure to property, either through, through their own personal exposure as well.
Great. Well, thanks both of you. We're actually 45 minutes in now, so I think I'm going to take some questions from the audience. And actually, Ian, we've obviously just been talking about commercial property, but I've got somebody's written in and asked, what do you think of other perhaps more exotic sources of income, such as infrastructure, investment trusts, retail bonds, and the like?
Yeah, so I think for us, these assets, are always worth examining in some detail. I mean, ultimately, you've always got to be certain that by buying something with an attractive yield, you are not taking on inherently more risk than you're comfortable with, firstly. So, is there a reason why they need to pay this amount of yield to attract capital? I would argue, and you can see through through mini bonds and the classic example, say going back a while, was the high yielding cash ISAs from Icelandic banks back a decade ago. So that's the first thing. The second thing is a lot of investments which are structured to provide a yield or people find appealing because rates are low often key off the same ultimate drivers. So, you know, infrastructure assets are ultimately priced on a series of cash flows, which then need to be discounted at different rates as well. So, you know, something that is based on a yield often relies on underlying interest rates, and the attractiveness of those assets could change as interest rates change as well. So if people don't like bonds because they think rates will go up, maybe they should think about the other things that they shouldn't like if rates go up.
Yeah, and I think thinking about the risk is the really important part there. So hunting for these other sources of yield, just make sure you're comfortable with the risks that are associated with them. Remember, going back to that idea that income in itself is not defensive. It depends on the characteristics of that income and where it comes from.
Another question. This one's actually very different. I think this is more for you, Matt. It's on the planning side. You spoke briefly about equity release earlier on. What kind of role do you think that can play? Because obviously a lot of people have got a lot of money tied up in their houses. That's not something that we at MoneyWeek necessarily have always approved of. And certainly you shouldn't think of your property as your pension. But equally, there is an element whereby when people reach retirement, one of the biggest assets is their house, and a lot of the time it's likely to be paid off. So what is your take on that? How should people go about incorporating that into their thinking?
Yeah, I mean, I think lots of people do it naturally anyway. So when they retire, they move from the family home, they release some equity and move to another home. What's becoming more prevalent now and people are thinking about is products that are designed to allow them to take debt out of their property, release that equity for them to spend now. And I think it's just about being sensible about the mix of what that means for you, thinking forward, again, planning as to whether there are pros and cons to that, and what it can be done. If you want to get technical about tax planning for inheritance and so on, there can be really clever things you can do around that. But I think generally our adage is to try and keep things simple, and you are adding another layer of complexity with a product that and make sure you really understand what it is you have and haven't got yourself into. The key thing is to look at the assets, the liquid assets you have, plan for a level. If you think you need to release more capital to fund your lifestyle, the first thought should probably more be about whether you move property and release capital that way. Then think about the idea of equity release and what would be done there. But just be aware that the providers of this are not doing it for free. So there are lots of costs and risks associated with it as well.
Yeah, that can be a pretty expensive area still to wander around in, and I did notice that the FCA recently has been issuing some guidance on equity release. So, so yeah, if it's something to be careful of if you're considering it. Another question, I think this one actually is for both of you. What do you suggest the most sensible percentage split would be for a resilient portfolio if you were about 7 to 10 years from retiring or winding down gradually? That's an entire session in itself. Give us your big picture view. Do you want to start, Iain, or not?
Well, I
Well,
think
I
I
was
think
just
it depends. Sorry, Matt, I think it depends. Just what you mean by resilient, right? Everyone has a particular threshold of what they think is an acceptable level of volatility, and you know, we've seen to date that different areas of markets can respond in different ways to different environments. So, I think it's tricky. It's tricky to know where to go with just a word like resilient. I mean, I'm sure Matt, you've got thoughts on what 7 to 10 years from retirement, and then what you're investing for beyond that means as well.
Well, I think that's it. You've still got a long way left into your retirement of your cash flows. There's a slide actually that we could look at just now that would probably help us think about that in terms of the fact that it's a long way left of drawing down still to come. So if we're thinking about the idea that we're going to draw income for many, many years, you're going to want to think to have a more equity than you might consider. Resilience, of course, we often think about how much it might draw down and fall in a given period, but we are needing to take more risk than you might think. If you're going to be drawing from it in the future, you're only going to be drawing a very small percentage on month one or week one. You're not taking out everything at that point. So I think it's probably going to have a higher equity weighting than you might think, but you need to be comfortable with the characteristics that could move. So if I take our risk level 4 portfolio that is sort of 50% equities, 50% bonds, that's quite resilient in lots of circumstances. It hasn't seen, in the most recent sell-off, it's done relatively well. It's given you around 50% protection in that you saw around a 10% sell-off. But in history, you have to accept that portfolio could sell off 20% in any given period before it recovers. So it depends what you mean by resilience, going back to Iain's point, but all I would highlight is that you need to take a bit more risk than you might think, because 7 years from retirement is not 7 years from everything stopping. It means you've probably got an average life of your future cash flows somewhere in the region of 25 years to 30 years. So you've still got a very long time horizon.
And going back to that horizon, we talked about inflation a little bit. You need to be willing to take enough risk that you're not incrementally disappointed by the investments you're making not keeping up with that inflation rate, and so that's where a level of equity risk really will be vital for you to maintain your purchasing power through time.
Yes, well, I'm glad you brought up inflation, Iain. That's perfect timing, because I've just got another question. I know we've mentioned it a bit, but obviously we've printed a lot of money. The government's spending a lot of money. We've seen gold go up sharply, which, despite what we said earlier, tends to be a kind of harbinger, at least a sign that people are slightly worried about inflation. How can you go about protecting yourself if you do have, as you say, 20 years of retirement to go? How should that change the way that you think about your portfolio construction, or should it not have any impact at all?
Well, so it's a great question, and it's a massive question in terms of the direction of some pretty big themes. We spoke a bit about this on our investment committee this week, and although the immediate impact of what has happened this year has clearly been very deflationary, and the markets are telling you that they think that it's going to be deflationary for a given period of time. I mean, you saw long-dated UK government bonds reach the same yield levels this week as their Japanese counterparts, which would have been unimaginable a few years ago. And the bond markets had a pretty good track record in terms of anticipating these types of things. If you think back, going back to QE, a lot of people worried about inflation then and thought that bond yields were going to be forced higher. And yet central banks have found that over the past 10 years, they've had difficulty generating enough inflation rather than having to worry about too little. So first, I think we have to, you have to make sure that you're not jumping the gun in terms of anticipating this change in very entrenched sort of structural challenges on the inflation front. Our colleague Gerard Lyons was saying that it could change maybe from either from the demand side, which is where policymakers say keep policy structurally far too easy for too long, and you might see a that eventually create a problematic environment, or maybe there's more challenges on the supply side. So we know that supply chains have come under stress. That's going to drive intermittent pricing challenges, and also might mean that people are a lot more cautious in the way that supply chains are created in the future. So that could be a threat as well. But you know, inflationary expectations are still so entrenched at such low levels that it's really going to have to take something big to really drag them into a different spectrum, I think. So our base case is still that inflation remains at relatively well behaved levels, as we've seen. Now, how you protect for significant changes is a big question. Yeah, you would expect that commodities do go higher if we imagine that real rates stay lower. It's not necessarily true that they will. But if they do, then you can imagine that precious metals would do well as well. But there could be environments when they struggle as well. So I think it's important just to keep an open mind and review where we're at in terms of the overall inflationary environment on an ongoing basis. It's going to be very difficult to pick a portfolio now that you can see not changing for the next 20 years or so.
Well, thanks. We've only got a couple of minutes left, so I think it's probably time for one more question. This one addresses something which is actually quite different to anything that we've talked about, and it is, should I be investing some money outside sterling, given the risks to the UK economy, and given that Brexit, there's that dreaded word, is still in the background? And if so, how much?
Well, I think, yeah, I think we've been reminded, of the past few years of how not just domestic political risk can impact a currency, but also the way that our economy behaves in relation to the broader environment. And so certainly you should have some money invested internationally. Now, you could argue that sterling's at a pretty competitive rate against its peers. So, we have to caution against against that some of that value being generated. But yeah, absolutely, you should invest internationally. We invest about 2/3 of our equity portfolios on an international basis, and then we think about the currency separately, and that's changed through time. This year, we've had less sterling in portfolios than historically, as you saw that period where sterling rallied particularly strongly at the back end of last year. But now it's clear that despite the broader economic picture, some of the the idiosyncrasies that the UK is facing and subject to could come back to the fore. So absolutely, a diversified currency exposure is the right approach.
Great, thanks, Ian. I think we have time for one very, very brief last question. And this, it goes for both of you, because it's basically kind of forecasting, so get your crystal ball out. Do you expect a V-shaped recovery?
I don't know. The more I read about this, it seems that people's interpretations of what a V even is seems to change day by day. So I think it's pretty difficult to ascribe anything like that. I mean, it's clear that we think that you'll need to see improvements on the health front to see a sustained recovery throughout the world, and there are some signs of optimism. A lot of different competitive developments for finding vaccines for the for the virus. Um, Notwithstanding that, you have to wonder how behavior is going to be impacted in the lead up to that period and then also beyond it. So, um, I don't think you necessarily, or we necessarily, need to see a proper V in terms of recovery to be able to make good investment gains, but it would certainly help everyone's investment portfolios, I thought, with a bit more good news.
And I don't have any more insight as to whether it will be a V or not, but I think what I can say is you shouldn't bet too much in one direction or the other. And this is the point of the longer term view. I can tell you, if you're thinking about a 30-year retirement, there will be multiple recessions in that time period that you'll have to withstand. And trying to call them right or wrong is much more likely to impact your ability to meet your goals than not worrying about it too much and matching up your objectives and accepting there'll be some ups and downs through the journey. I think that's probably the most important takeaway.
Yes, multiple recessions, but hopefully not multiple pandemics. We'll see what happens. Well, look, thank you very much, both of you. Really appreciate that. Iain Barnes and Matt Conradi, both of Challenger Wealth Manager Netwealth. If you do have more questions, then Iain and Matt or Netwealth will all be happy to hear from you. And really, it just remains for me to say thank you very much for tuning in. Really appreciate it. Hope you enjoyed it. As I say, if you have any questions, get in touch with Netwealth and they'll be able to help you out. And yes, stay safe, and we'll see you again soon. Thank you very much.